Okay, welcome to Chapter 6, where we're going to expand on some of the themes that we talked about, that we introduced in Chapter 5. And we're now going to look at some of the advantages and disadvantages of breaking out financial statements or information based on their cost behavior. So if we look at slide 5, we're going to spend a little time on this slide because we're going to introduce you to two concepts. One is absorption costing and the other is variable costing. And we're going to see how income differs whether we use a variable cost basis or an absorption cost basis. So let's talk a little bit about each of these. Let's go to slide 8. And if you follow along with me, what we do in absorption costing is that we take direct materials, direct labor, variable overhead, and fixed overhead, and we put all of those into product cost. Now notice the first three items, direct materials, direct labor, and variable overhead, under our cost behavior definitions, those are all variable costs because, again, to refresh your memory, the total direct material cost is going to move up or down as the number of tables that we make moves up or down. The same with direct labor, the same with variable overhead. On the other hand, our fixed overhead, as we learned earlier, that's going to stay the same regardless of whether we make 1 table or 20 tables or 200 tables. So, under absorption costing, we take all of these product costs, or all of these costs, and collect them into the product cost. Now, let's compare that in the next slide with variable costing. And in variable costing, what we find is that we take only, as the name indicates, we take only the variable items, direct materials, direct labor, and variable overhead. We put those into the product. We take the fixed overhead and we treat those as a period cost, because then we don't have to fool around with, do we allocate the cost, the fixed overhead costs, do we allocate it to 1 table, 20 tables, or 200 tables? So if we move to slide 11 now, we actually compare the two. And here we have a side-by-side under absorption and variable costing, and you'll notice that we get two different unit product costs. Direct labor is the same, direct materials is the same, our variable overhead is the same, but our fixed cost per unit under absorption costing are included in the product cost. In variable costing are not. That is the entire difference in the two costing methods is how do we treat fixed overhead in product costing. So then if you'll follow these next slides, and they will give you 3 different income comparisons, because we will have situations when the units produced are equal to the units sold, and that's covered in slides 13 to 16. I'm not going to go through those here because you need to sit back and study those. But essentially, when the units produced equal the units sold, our net income is going to be the same under each method. In slides 17 through slides 22, we look at the example where the units produced are greater than the units sold. And if you move finally to slide 26, you have a summary of the 3. And here you'll notice that in 2008 we had more units produced than units sold, and absorption costing gave us a higher net income than variable costing. And then not going there, but staying here in the summary, if you go to slides 23 through 25, that's where you'll see the situation where units sold are greater than units produced. And in this situation, variable costing gives us a higher net income than absorption costing. So this now becomes a planning tool for us Because again, remember, we allocate these on a predetermined overhead rate. So we have two choices. Do we produce too much inventory or do we produce too little inventory? The danger in producing too much inventory is that we have excess inventory. And so you say, who cares? That way we never lose a sale. But think about it, if you are a computer manufacturer like Dell or Acer, and you manufacture your own chips, and you build a 6 months inventory in chips. Well, as we know in the computer industry, within 6 months, that chip has become obsolete and is replaced by a new, higher, faster, greater capacity chip. So that argues, technology argues, why we do not build excess inventory as well. It costs money to carry unsold inventory. On the other hand, then, if we produce too little inventory, then we're going to lose customers because we will lose sales and our customers will go elsewhere. Finally then, if we go to slide 37, we're going to talk about the limitations of variable costing. First and foremost, absorption costing is required by GAAP. Again, GAAP is generally accepted accounting principles. Absorption costing is the required method for any external financial report. Therefore, variable costing, again, is a tool that is used only internally, but it requires you, again, going back into the very early chapters, the whole difference between the two is cost behavior. So critical to all of this, all the way through chapters 5 and in chapter 6, is you must accurately determine your cost behavior as to whether those costs are fixed or variable or even mixed or step costs. Otherwise, we don't have an accurate base for making our decisions, but realize that for external reporting, absorption costing is the only method recognized by generally accepted accounting principles.